Most people never become wealthy. That's just the truth. Not because they don't earn enough or because they aren't smart enough, and not because investing doesn't work. We're going to look at why this happens, the psychological trap that catches almost everyone, and why wealth building feels broken during the exact stage when it's actually working, so you can avoid it. Because what if the reason you're not wealthy yet isn't because you're failing, but because you're in the exact stage where almost everyone quits? Most people quit building wealth early, not all at once, not dramatically. It happens quietly if you aren't paying attention. Lots of people try for a little bit and then just stop investing and stop saving. The crazy thing is, most people quit right before things were about to get interesting, right before the effort, sacrifice, and energy that they've poured in for years finally begins to transform their lives for the better. So let's break it down and get into it. The first reason is the invisible progress problem. Imagine you decide to get healthy. You start exercising, you eat better, you sleep more. Then, after 2 weeks, you look in the mirror. Nothing seems different. Most people would feel discouraged. The problem is that humans are wired to expect visible rewards for effort and programmed for quick feedback. But wealth doesn't work that way. In the beginning, it feels like you're doing everything right and getting absolutely nothing back. You save, you invest, you make sacrifices, and your account barely moves. This creates one of the biggest psychological barriers to building wealth. You can't see progress. Researchers studying goal achievement have repeatedly found that visible progress dramatically increases persistence and motivation. When progress becomes difficult to see or detect, people are far more likely to quit. And that's exactly what happens with money. The early stages of wealth building are almost entirely invisible, which leads to the next problem. Next is the effort reward mismatch. Let's say you invest $500 every month. After an entire year, you've contributed $6,000. You've made sacrifices, skipped purchases, stayed disciplined, and yet your investment gains might only be a few $100s. Emotionally, that feels disappointing. Your brain starts asking a dangerous question. Really? 1 year and this is it? This is dumb. Is it even worth it? This is where many people begin to check out because the reward doesn't seem proportional to the effort. But here's the reality: the average investor dramatically overestimates what wealth should look like in those early years. A study from the financial industry found that many new investors expect returns several times higher than historical market averages. When reality doesn't match expectations, motivation collapses. People assume the strategy failed, when in reality, they simply haven't stayed in the game long enough. And that leads directly into the biggest misconception of it. Wealth doesn't grow in a straight line. Most people imagine wealth growing like a staircase and that it's steady and just increasing over time, a little more every year, a steady upward climb. But wealth behaves more like a snowball rolling downhill. At first, it barely moves, then suddenly it's unstoppable. The reason is compound growth. In the beginning, almost all progress comes from you, your savings, discipline, effort. But eventually, your money starts contributing too. Then your gains start producing gains, and those gains start producing even more gains. Albert Einstein may or may not have called compound interest the eighth wonder of the world, but regardless of who said it, the principle is powerful. Historically, the US stock market has returned roughly 10% annually before inflation over long periods. The problem isn't that compounding doesn't work. The problem is that it's super slow before it works much faster later on. And most people quit before reaching that transition point. There's a phase in almost every meaningful goal called the valley of disappointment. It's the gap between effort and visible results. Athletes, entrepreneurs, investors all experience it. You keep showing up, but the outcome doesn't seem to justify the work. Picture planting a tree. For months, you water it, protect it, take care of it, yet above the surface, almost nothing changes. Meanwhile, underground, roots are spreading everywhere. Wealth works similarly. According to data from the retirement account providers, many workers stop contributing during market downturns or after periods of slow growth. They assume nothing is happening. But beneath the surface, the foundation is being built. The tragedy is that the valley of disappointment often occurs immediately before exponential progress begins. And that's where the next trap appears. Next is the comparison trap. Someone else always seems to be moving faster. Social media has made it way worse. You're scrolling through stories about crypto millionaires, entrepreneurs, selling businesses, investors retiring at 35. Suddenly, your own progress feels meaningless. But comparison destroys wealth because it changes the game you're playing. Instead of measuring your progress against your past self, the only person you can compare yourself to, you start measuring against someone else's highlight reel. Research consistently shows that social comparison reduces satisfaction and increases feelings of inadequacy. And when people feel like they're losing, they often stop playing. What they don't realize is that most wealth is built quietly and slowly. No headlines or viral posts, no overnight successes, just years of boring consistency. And boring consistency isn't very exciting, which creates another problem for why people quit too early. The boredom barrier. Nobody talks about how boring wealth building actually is. The formulas are super simple: spend less than you earn, invest consistently, avoid unnecessary debt. So the challenge isn't complexity, it's patience. Humans crave novelty. We like excitement. We want action. That's why speculative investments often become so popular. The next crypto coin or hot stock. The possibility of getting rich quick feels way more exciting than slowly becoming wealthy. Yet, research from Dalbar has repeatedly shown that average investors tend to underperform the investments they own because they jump in and out of at the wrong times. They get bored, they chase trends, and abandon the plan. And the irony is that the most effective wealth building strategy is often the least exciting. And that boredom causes tons of people to leave just before the results appear. Nothing reveals your true way of thinking like a market decline. When everything is rising, everyone feels like a long term investor genius and that they would be fine if it dipped. They're blinded by the returns. But when portfolios fall 20%, 30%, or 40%, emotions take over. Fear becomes louder than logic. Many investors sell because they want the pain to stop. Historically, though, some of the strongest market recoveries have followed major declines. Yet, investors who panic and exit often miss those recoveries entirely. Data from multiple studies shows that missing just a handful of the market's best days can dramatically reduce long term returns. The challenge is that those best days often occur very close to the worst days, meaning the people who quit during scary periods frequently lock in losses while missing the rebound. And that brings us to the biggest reason people quit. Most people track wealth using the wrong metric. They look at account balances, the monthly returns, and recent market fluctuations. But because those numbers move constantly, motivation rises and falls with them, like an emotional roller coaster. Wealthy people, though, often focus on a different scorecard: building ownership, making systems, establishing habits. They focus on things they can actually control, asking questions like: how much am I investing? How consistently am I doing it? How much assets do I own? Because habits and systems are controllable. Markets aren't. Income isn't always, and the economy definitely isn't. But your process is. And the people who focus on process instead of short term outcomes are far more likely to stay in the game long enough to benefit from compounding, which leads to the final lesson. The greatest challenge in building wealth isn't finding the perfect investment. It isn't predicting the next market winner or timing the economy. It's staying in the game. That's it. According to Federal Reserve data, a significant portion of Americans, 42%, have little or no investment exposure outside of retirement plans. Not because opportunities don't exist, but because consistency is hard. The people who ultimately build substantial wealth are often not the smartest, not lucky, or not even high earners. They simply are the people who didn't quit. While others stopped investing, they kept going. While others got distracted, they stayed focused. While others chased the shortcuts, they trusted the process. Because wealth isn't usually built by massive actions, it's built by ordinary, smaller actions repeated for a long time. And I want you to hear and focus on this last point because if you stay to the end, you're the real ones. The uncomfortable truth is that the moment when you feel the least motivated to continue and when you're done and you want to quit is often the exact moment when continuing matters most. If you found this video helpful, hit subscribe and let me know in the comments. What financial milestone are you working on right now? And more importantly, what will keep you from quitting before you get there?